The US central bank raised its benchmark lending rate a mere 0.25% on Wednesday, but the impact was immediate. The average mortgage interest rate is now above 4% for the first time in nearly 3 years. That means higher mortgage repayments at a time when inflation has sent food and fuel prices soaring. But consumers strolling past the US Federal Reserve think prices need to come down.
Prices of housing have skyrocketed lately, and things need to calm down maybe a little bit. Maybe they're making the right move here.
It's crazy. I mean, $5 for a 6-pack of Dr. Pepper.
The Fed had always intended to eventually raise the main lending rate it slashed to near zero to help businesses and consumers through the pandemic. But the inflation crisis has forced it to intervene aggressively. And some analysts think it'll have to raise that rate from 0.5% to 2% by the end of the year to stand any chance of reducing inflation, now running at around 8%.
The Federal Reserve has been accused of reacting too slowly to surging inflation by keeping its benchmark interest rate too low for too long. But Russia's attack on Ukraine and its effect on oil prices is now making some experts wonder if raising that rate will put the US economy in danger.
But its chair doesn't think so, even with once rosy US economic growth forecasts now being downgraded.
The probability of a recession within the next year is not particularly elevated. And why do I say that? Aggregate demand is currently strong, and most forecasters expect it to remain so. If you look at the labor market, also very strong.
And if US consumers are braced for higher borrowing costs, spare a thought for those in Brazil, whose central bank raised its main rate on the same day as the Fed to nearly 12%, with the average interest on a credit card now a staggering 346%. Owen Fairclough, CGTN, Washington.